Hi everyone and welcome to the Everyman Investor. Since my last video, CPI and PPI came in a bit hot, but the main stars of the show were the Fed members and especially the Fed meeting and the outcome of the Fed meeting in the past week. So the good news is rate cuts are in sight. So what happened during the Fed meeting for the March 24 meeting? All the data I've gotten is from the Federal Reserve website itself, so it's all first-hand data. The Fed still chalks in a 3 times 0.25% rate cut for 2024. GDP growth actually has been revised upwards by the Fed members from 1.4% that they expected for 2024 in December last year to 2.1% during this meeting. Core PCE was sort of revised upwards from the expectations of 2.4% in December last year to 2.6% in March this year for the 2024 target. So basically, in summary, the rate cuts that were on the table, the 3 rate cuts are still on the table. The Fed is expecting the GDP to grow more than was previously expected for the US economy this year. And happily, the Fed is sort of decreasing its expectations as for the rate of PCE dropping in this year. So let's take a look at the charts from the meeting. So this is the dot plot that I previously went through in the previous video. The most important thing is the 2024 dot plot for the immediate future. As you can see, the majority of the members actually have indicated they expect Federal Reserve to have the interest rates at 4.5 to 4.75%, which is basically 3.025% rate cuts from where we are now. Now, there is no mention of when they expect the rate cuts to happen. It's just that they expect to happen this year. And as you can see, the longer term, they expect the rates to go down to about 2.5% in the long run and about 3% by 2026. So, rates going down back to below 2% probably not going to happen unless the economy tanks. But the thing is, most people say that, in fact, a lot of the people who grew up in the or who were investing in the 70s and 80s actually say that the current rates are unrealistic. That 0% rates that have been happening over the past few years is basically not something that is the norm, and that they actually grew up with rates a lot higher than they are now. So I would say that about 2 to 3% is probably not unreasonable for the long run, and that it will probably be about half of what it is now at the moment in time. Now, here's the GDP projection. So for the Fed members, some go somewhere from 2% to about 2.5% for the majority of the members, and this is up from the previous projection in December when they released their last dot plot and the charts. For the PCE, which is what we're interested in, the core PCE projections for 2024, as you can see, the majority of members actually indicated that they expect core PCE to moderate to about 2.5 to 2.6 year over year percent increase year over year for 2024 compared to 2023. And they only expect the target of 2% that they always talk about in 2026, you can see in the last slide, last part of the graph here. Now let's take a look at how PCE actually has been going. So it was 3.19 a couple of months ago. Went down to 2.94% year over year last month, and the latest reporting was 2.85% year over year. Now, for it to go down to 2.5 to 2.6%, if it drops at 0.1% year over year every month, then we would probably expect the rate cuts to start coming in somewhere in the region of June or thereabouts, which is actually when the market is pricing in the first cut. So which is pretty good news because lower rates, lower interest, higher borrowing rates leading to growth expansion for companies. And also lower interest rates leads to lower interest payments, again leaving more money for companies to grow and reinvest their earnings. Now, the other thing I found interesting was the unemployment rate projections, which is about 4% or so for the majority of Fed members. Now, current unemployment is about 3.7 to 3.9%, which means to say it's almost at the range where the Fed members actually expect it to be, which means that the labor market should be taken out of the picture in terms of Fed considerations for rate cuts unless the labor market strengthens tremendously, which hopefully it does not. And then keeping unemployment low will help the economy along, as consumer spending is basically the main driver of the economy and GDP growth in the United States. So what needs to go right for us as investors? Core PCE needs to continue its downward trend, which it looks nice at the moment in time, and let's hope it continues going in the right direction. Now, GDP growth needs to continue. So as I mentioned, consumer spending actually is the majority of GDP growth in the United States. The main problem is that a lot of the savings have been depleted, and a lot of people are actually buying on debt. Buy now, pay later is extremely popular nowadays. In fact, in another country that I sort of monitor, the grocery stores are actually rolling out buy now, pay later for groceries, which is worrying and sad at the same time. If you need to borrow to buy your groceries, it probably means that the consumer is really not doing very well. I have not seen that in the US yet, and there's no news of that going on in the US yet, but if this is the indication of what higher interest rates, and that country actually does had a great increase in interest rates over the past year or two, in parallel to what the Fed has been doing. So let's hope that the US economy stays a lot stronger than other countries. Now, unemployment and jobs data actually do not need to do anything except just to stay in line with expectations, and that will be fine because, as I mentioned, the unemployment rate is almost at the Fed's target rate, so that's pretty good. And earnings need to grow. Basically, how stock prices go is that the earnings per share growth usually tracks the stock price. So basically, earnings growing will help with stock prices and basically help us as investors to make more money. And of course, no black swan events. The most obvious thing I can think of is a conflict in the Asia Pacific region, which is China and Taiwan, or even in the South China Sea region, with China being increasingly aggressive, and as other countries continue to push back against China. The recent events in Russia with the ISIS attack, if you've been keeping up with the news, that just happened last night, this morning, is another issue. Although, to be perfectly honest, if Russia intervenes in one of the sort of Eastern European, Western Asian countries where things are honestly very murky, then it probably will not affect global events much. The last black swan event I can think of is if there's unrest in the US, mainly from political forces, and the elections, which is somewhat of a concern. Hopefully, everybody stays sensible, and things don't get out of hand, and we can continue to invest in the US confidently rather than have to pull money out of the US and look around for other places to invest in. So that's all for this video. The next earnings season will be coming out in April, and it should be interesting, given many of the tech stocks seem to be doing pretty much in a holding pattern recently. Even Nvidia stock has given up a bit of its gains. Apple is doing very badly. Tesla definitely doing badly. And whether or not they can restart to grow their earnings again, because Apple has been having revenue declines, as well as sales declines, especially in China. And the CEO has recently gone to China to talk to business leaders there. But all this is all in the realm of geopolitics, with China banning US products, US banning China from getting semiconductors, etc. And things like this basically are the black swan events that I'm talking about, in a more minor degree, but it does affect companies' profits. So I hope this was useful, and I hope to see you in my next video, and I hope you have a good time with the market rally since the Fed announcement.